Good morning, everybody. Thank you very much for attending this session. I'd like to talk to you about Japanese small caps, as you heard from Annabelle. We've all heard a lot over the years about small caps generally being out of favor, being undervalued, and being a great opportunity. And in many cases, we're still waiting. And what I'd like to expand upon and explore with you today is that hope is not a strategy, but thankfully in Japan, there's a lot of change afoot. There are a lot of things happening, and that makes Japanese small caps not only a cheap sector of the market, but also a sector with a catalyst where things are actually happening and cheap stocks are becoming more fairly valued. Okay, so we launched AVI Japan Opportunity Trust in 2018, 6 years ago next week, in fact, and it's roughly £200 million of assets. And we launched it to exploit precisely these small cap opportunities that I've alluded to and that I will expand upon. In that time, we've outperformed our benchmark, the MSCI Japan small cap, by quite a wide margin and generated pretty strong positive returns for our investors. These returns would have been well over 100% in yen, but obviously, as we'll talk about, we've suffered from very strong devaluation of the yen over the last few years. We're a team predominantly based in London, but we have one colleague who's based in Tokyo full-time. The team comprises a few Japanese nationals, which is important when you think about our approach, which involves very intense discussions, engagement with the companies that we invest in. So let's talk about the opportunity, why it exists, and why I think it's so exciting. Like many small caps, Japanese small caps are unloved, they're under-researched, they're neglected and overlooked by investors, and so there's a lack of knowledge about these companies. Particularly amongst Japanese small cap companies, the IR communication is poor, they don't get out there and tell the story, and so share prices remain depressed, nobody cares. In addition to that, a particular nuance of the Japanese market is that ever since the bubble burst in 1989, 1990 in Japan, Japanese companies have feared going through an existential crisis again. And to that end, they've accumulated blindly cash on their balance sheet, cash for a rainy day is the mantra. That cash sits there earning nothing. Japan is a very hierarchical culture, and anybody joining the company gets told the cash belongs to the company, and when a shareholder asks you, what about the cash? You're told to explain the cash doesn't belong to you, shareholder, it belongs to us, the company. A very subtle but important difference in the Japanese market. And as time has marched on, investors have lost interest in the cash on the balance sheet because they've realized it's never going to be theirs and doesn't mean anything to them. And so when you look at valuations of Japanese companies on an enterprise value basis, adjusting for the cash, you're able to invest in really good businesses at ridiculously low multiples. When you look at these companies on a price-earnings basis, they look quite reasonable. But when you look on an enterprise value, EBIT, multiple basis, they look ridiculously cheap. And that is because the cash is being disregarded. And so we were interested in these two features. The fact that you could buy very cheap companies and very undervalued companies, and particularly you could buy companies with, in some cases, 100% of their market cap in net cash, something you couldn't do anywhere else in the world. Pretty safe. But the key really to unlocking value is the regulatory tailwinds and the corporate reform that have been introduced over the years. It started as the third arrow of Abenomics. The first two arrows of Abenomics focused on monetary policy and fiscal policy. The third arrow focused on structural reforms. And as part of those structural reforms, they introduced a corporate governance code and a stewardship code. The corporate governance code said to companies, for too long you've disregarded the interests of shareholders, you focused on employees, you focused on your pensioners, but you haven't been interested in the share price. It's about time you start generating healthy, higher returns on equity and focusing on shareholder returns. And shareholders in Japan have for too long ticked the box every year in the AGM, support the directors, vote for all the resolutions, never criticize, never shame management. And so the stewardship code said, start acting as owners. If you're not happy, say so. Give them a hard time. And as part of that process was dialogue. 10, 15 years ago, Japanese company management would not meet with investors like us. They didn't think it was their job, and they weren't interested, or they were scared. So these codes were introduced in 2014 and 15. And when we launched the trust, we argued this time was different and that Japan was changing. There was a lot of skepticism and cynicism about that. But I think, as I'll show you, the argument has now moved on. Japan has changed. And when we're seeing companies in Japan, management are interested in the share price. They want our ideas. They want to hear our suggestions as to what they can do to get the share prices higher. And corporate governance standards have improved. And it's a completely different marketplace to what it was. But we are talking about Japan, and Japan moves slowly. But they are undoubtedly committed to these reforms. So the key is shareholder engagement. It's no good just buying a cheap company and then hoping that the rising tide will lift all boats and your share price will go up. It's about engaging. And Japanese shareholder activism has got a checkered history. 20 years ago, a group of American investors showed up in Japan, bolshy, aggressive, loud, thumped their fists on the table, demanded their cash gets returned to them, and started telling companies how to behave. It didn't go down well. The activism of the last 7, 10 years is different. It's much more respectful of the culture of Japan, the way they conduct their businesses. But it's also become a little bit more forceful as well, but forceful in a constructive way. So rather than simply put out aggressive shareholder resolutions to AGMs, investors explain the rationale, educate other investors, and try and work more in collaboration with management. So when you look at the opportunity today, you see that despite, as I said, our performance being well over 100% return over the last 6 years in yen, we still have a portfolio that's trading on a multiple well below the small cap index and a long way below the general index. You'll be aware that large cap Japan has performed very well over the last 18 months. It's hard to argue that there's a lot of value amongst large caps, but I think it's much easier to make the argument that small caps remain cheap. So to encapsulate what I've said earlier, we've had Abenomics, we've had the Stewardship Code and the Corporate Governance Code. And then what's interesting about the process in Japan and the introduction of the code is that in a very Japanese way, the regulators had in mind what they wanted to achieve, but they didn't actually come out and say it explicitly. But what they did say was that we will alter the codes each year following feedback from market participants. And that has been the case. And as time has marched on, rather than be a bit roundabout as to trying to guide companies to an end game, they've become much more direct. And this year, what we've seen is the Tokyo Stock Exchange come out and say to companies trading below book value, that's not good enough. Too many companies in Japan trade below book. You now need to come to your shareholders and explain what you're going to do about your discounted valuation, over what time frame they can expect the share price to go up. And that's led to a lot of pressure, particularly on small cap companies, where you find lots of examples of companies trading below book, to think about what they can do about their share price. And many small cap companies, the management there have run out of ideas. They've gone 20, 30 years without being pressurized by shareholders. All of a sudden, they're being told, you've got to get the share price up, you've got to get the profitability up, you've got to make your company more valuable. And so it's an opportunity that's really ripe for shareholder engagement, for the right kind of shareholder engagement. And our approach to engagement is typically private. It's always constructive. It's never bullying and aggressive for the sake of it. And in 8 or 9 cases out of 10, I would say, it's worked to the extent that companies have got kind of an implicit contract with us that they will do what we say, provided we keep this out of the limelight and we don't embarrass them. As you all know, and as Annabelle mentioned in her introduction, however, whilst Japan went through a period of favour over the last 18 months, and foreign investors in particular increased their allocation and recognized that things were changing in Japan, they got a rude awakening in end of July, beginning of August, when Japan went back to its highly volatile, bad days over a 3 or 4 day period. And the volatility was extreme. Some of our companies fell by 20, 30% over the space of 3 days. It's pretty frightening stuff. And clearly that was caused by a variety of different factors. It started off in response to a very small incremental increase in interest rates by the Bank of Japan, and perhaps language around future intended increases that led to some reversal in the carry trade. The yen has been a very popular funding currency. The yen has been very weak, so that's been a very profitable trade. And it probably also conspired with a time of year where markets are relatively quiet, and then when the machines got involved and the algo trades exacerbated things, you saw those very extreme moves. The key really from our perspective is that from a fundamental perspective, the attitudes in Japan towards corporate governance reform and shareholder returns have not changed one iota. Operationally, our businesses were not affected. In our case, our portfolio is roughly, in terms of sales, at least 80% is exposed to the domestic market rather than the export market. So it's a completely different environment to those large cap exporters that were very vulnerable to a setback. So will the yen ever go up? I've given up trying to answer that question because I've been saying for the last couple of years that it ought to go up. What I can say, though, is that from a fundamental basis, things in Japan have improved. Okay, we're out of line here. Sorry. Okay. From a fundamental, we caught up. Things have improved. We've started to see inflation come in, and importantly, we've seen wage inflation come back into the economy. And that's really feeding into, I wouldn't say firing up the animal spirit necessarily, but it's certainly seen a turnaround away from the deflationary mire that has afflicted Japan for so long. We've also started, we've also seen a bit of a pushback from people in Japan to the weak yen. And that's led now to revised rhetoric coming out of the Bank of Japan about future moves. So I would say that the fundamentals support a higher yen. In terms of the population of Japan, they're very against a weak yen because it's very inflationary for them. And clearly what's been driving it has been the rate differential between the Fed and the path of US interest rates compared to Japan. But it's a very brave person who tries to predict moves in foreign currency markets. But going back to our fundamentals, what I would say is that when you look at what's gone on in Japan, when you look at the number of activist shareholder proposals, it's been a strong increase over the last 5 or 6 years. When you look at the number of independent directors on boards, it's a completely different environment. When you look at companies buying back, when we started this, it was rare for companies to buy back shares. Today, hundreds of companies in the Japanese market are buying back shares. And when you look at cross-shareholdings, that really big issue that's afflicted the Japanese market, the fact that there's all these strategic shareholdings and allegiant shareholders, they've started to come down. There's still a long way to go. And that really is the message about Japan. It has changed. The commitment to shareholder returns has turned a corner. There's a long way to go, which is why it's still a rich opportunity set. But those who say that Japan will never change, I think, have missed a trick, and the evidence points to that. So just a few words on our portfolio and how we go about investing. The key message when you just look at our portfolio, I appreciate the names won't be familiar to many of you, but the key really here is that we take a very concentrated approach. The top 10 currently make up over 2/3 of the portfolio. At times that goes above 70%. It reflects the fact that our engagement with these companies is extremely intense, and we want to return on that investment when things go well. The portfolio is currently, the top 10 is made up of a mix of quite long-standing investments. Some investments have been there from day one. Some have come in the last few months. All of them, as you see in the final column, all of them have got a net financial value as a proportion of the market cap. That's pretty high. That's cash plus listed securities as a proportion of the market cap. So very strong backing. And the other key that I would highlight here is the proportion of AVI ownership. In many cases, we're the largest shareholder, and that gives us a seat at the table and opens up the possibility of dialogue and being taken seriously by management. The other thing is that you would have seen from the previous slide that some pretty strong returns over the years in some investments. We're still able to find quite a lot of new ideas. These are ideas that have come into the portfolio over the last year, with probably half of them coming in the last 4 or 5 months. Still able to find companies trading at earnings multiples of 0 or very low single digits, with very strong balance sheet backing. And interestingly, and this does move around over time, interestingly, some of the most interesting opportunities are the ones pretty far down the market cap spectrum, below 100 million pounds. Just a couple of examples to end off with before I'll take some questions. But Binos is interesting. A lot of people associate what we do as a value approach, and it is a value approach. We're looking at companies trading at discounts to cash on balance sheet, other assets on very low multiples. But we are able to find such opportunities in quite high growth businesses. Binos is the largest operator of cross-border e-commerce. Essentially, this is for people outside of Japan who are interested in Japanese culture, Japanese products, anime, and the like. They're able to purchase those goods on their platform. You see it's been growing very rapidly, and the value of its balance sheet assets, securities, cash, and other investments make up almost 2/3 of the market cap. So we're buying this very high growth company on a single-digit earnings multiple, which is very interesting. It's gone up a lot, but there's still plenty of upside. But the key here, and this really again highlights what's gone on in Japan over the last couple of years, is that 40% of the shares are now held in the hands of shareholder activists like ourselves. Us and one other own about 9.5% currently, and a couple of other shareholders, activists, make up the 40%. So we've got a very interesting AGM coming up in December in this company, where you'll see that whatever we might want to see happen is likely to be supported by the vast majority of shareholders. And that's increasingly happening. We're seeing other like-minded shareholders on registers, which is just making the whole process of engaging with companies that much more productive. And then final example from the current portfolio, Karabo Industries, sort of an old-fashioned conglomerate, some fairly boring businesses in there. One pretty good business and a couple of other mediocre businesses. But the key is, again, the balance sheet. This balance sheet comprises cash, listed securities, but also real estate. We've conducted our own valuation of the real estate, and today over 100% of the market cap is covered by the value of those assets, leaving us buying the operating businesses on a negative earnings multiple. Again, things that you can't really find elsewhere. Our strategy has worked. Our approach to engagement has worked. Fujitec was in the portfolio for about 5 years. It generated the returns that you see here, but it was a flagship activist campaign for us. We went public with a whole operational and strategic review of the business, making suggestions as to how they can improve the profitability. It's not just about getting cash back, it's about improving profitability. That's what companies want to talk to you about, and that's really what opens the door to a constructive relationship. And importantly, even when we went public, our relationship with the management team was not affected by that. But again, it shows how, having bought a company that was trading at a 6 times multiple compared to 20 times for its peers, has re-rated over the 5-year period, thanks to the company implementing a lot of what we suggested, and we exited when it was trading actually at a higher multiple than its peers. So I think I've run out of time, and I'm very happy to take questions. But just as a summary, Japan small caps are still cheap. I think the party's only just beginning. There's a lot of work to be done. There's a lot more acceptance of the whole engagement angle in Japan. And the market will throw up noise. The market will have volatility in the yen, will have volatility in the stock market. But these companies are fundamentally cheap in absolute terms. And when we do get a success, when we do get companies privatized or taken over, or when our active engagement yields positive results, you get an idiosyncratic return, which in these kind of markets is surely quite attractive. So thank you very much, and happy to take questions.
Thanks so much, Joe. I'm now going to take a question which we've had come in online. Somebody's asking, can you provide an estimated timetable for your realizations? And I like this part of the question. How do you work with intransigent management?
So when you say realization,
I think they mean sales, presumably.
Or they mean the
well, I don't know.
The redemption opportunity.
It hasn't. No, I would have thought they meant sales.
Okay.
Yeah.
So I guess there are two situations with regards to sales. The first is you get a takeover event. So that's happened to us probably 6 or 7 times over the years. You get a company that's taken over either by a competitor, parent company, or privatized by management. That's the easiest realization. Other straightforward realizations would be the company's achieved its full value, you sell it out in the market. So some companies are very illiquid, but the majority of companies have got more reasonable illiquidity. And then I guess the final situation is you can get stuck in companies. 2 things can happen when you get stuck in a company. You can call up the company and you can say, it's about time you did a share buyback. It'll be very accretive for your shareholders. And we're very happy to sell our shares in the buyback. And if we've been a real nuisance, sometimes they agree to buy back our shares. And other times they don't, and we can be stuck, and we have to just trade out of the market. We're stuck in one company at the moment, SK Kaken. We've submitted resolutions and been a nuisance for 4 years. We finally got a meeting with the president a month ago. So we are slowly making inroads there, but you can get stuck.
And that sounds like an example of trying to deal with intransigent management.
Absolutely. The family is in control. They own 40% of the shares. They're very old-fashioned. The president is 90-odd years old, comes to the office every day. And, I'll tell you very quickly, their share price was something like 40,000 yen. In Japan, under the stock exchange rules, they've got minimum lot sizes. So it meant that the minimum amount of shares anybody could trade was around $50,000. So we said that's going to put off a lot of retail investors. Do a stock split your shares into 10, make it a much more palatable lot size, and then you'll get more retail investors into your shares. And the president said, no, I don't like that idea. Why? I like coming into the office every morning, reading my Nikkei newspaper, and seeing a very high share price.
Well, what can you do with that? Okay, ladies and gentlemen, let's take some questions. There's one right at the back there. Megan's coming to you.
Thank you. In terms of the activism, what's your failure rate in terms of having to sort of throw the towel in because you could just have them being too intransigent. And I've always understood in terms of the Japanese investor, like Japanese companies, they're quite happy to keep cash doing nothing. Have you seen much in the way of movement of the Japanese retail investor actually supporting their own market?
Yeah. Okay, so the failure rate, it's hard to quantify. What I would say is that we've learned lessons over the life of the fund. And in the early years of the fund, we were probably seduced by situations with huge amounts of net cash and probably failed to consider adequately other factors such as the other shareholders on the register or the quality of the business. So we've had 5 situations where we were probably banging our head against a brick wall. In 3 cases, we managed to get the company to buy back our shares. In 2, we didn't. And in 1, we're still stuck. So more recently, the success of the engagement is more considerable, I would say. Your point about cash or retail investors buying their own market, the government recently improved or expanded the NISA, which is their version of the ISA rules, in order to encourage more retail purchasing of shares in the stock market. It has led to a marginal increase. I wouldn't say it's massive. And of course, the bigger driver would be if institutional investors who for so long have underinvested in their own market and preferred overseas markets, if they start investing some of that repatriated capital into the market, that would be a big support. But that remains one sort of negative aspect of the market, I would say.
Okay, we're going to have time. One more question, please. We've sort of got a minute or so. Don't worry, Joe's going to be around later to talk to you.
Hello. In your peer group, you're very similar to another trust, Nippon Active Value Fund. How similar and how different are you to that trust?
Well, I would say that we're both focused on the same opportunity set. The idea that there are lots of very cheap companies in Japan and that the way to unlock that value is through active engagement. I don't presume to speak for them, but if you look at what they've done, they've been a little bit more high profile, a little bit more active in the public domain, pushing companies to achieve returns for them, and they've done that very well. Our approach is more behind the scenes, more constructive, more focused on operational and strategic improvements and building a long-term relationship with the companies rather than getting a quick result.